What if I told you that the most powerful financial system in human history is quietly running out of cash? Not broke, not collapsing overnight, but running on fumes. And the people in charge know it. Here's the question I want you to sit with for the next 15 minutes. If the U.S. needs $12 trillion in the next 12 months and has less than $500 billion available without printing it, what happens next? And more importantly, what does that mean for your money? Because right now in 2026, that's not a hypothetical. That is the actual balance sheet of the United States government. And whether you're invested in stocks, crypto, real estate, or just holding dollars in a savings account, this affects you directly. Stay with me. By the end of this video, you'll understand something most financial media isn't talking about clearly enough. Let's get into it. Welcome back to the channel. If you're new here, we break down macro finance in plain English. No fluff, no fear porn, just the real picture. Today, we're going deep on something that's been building for decades, but is hitting a critical point right now in 2026. We're talking about the US dollar's role in the global economy, a concept called the liquidity crisis, and why what Trump is doing may actually be the most radical restructuring of the global monetary system since the 1970s. And yes, we're going to connect all of this to your portfolio before we're done. Let's start at the beginning. To understand the crisis, you need to understand the system. After World War II, the world built its financial architecture around one simple idea. The dollar is as good as gold. Literally. Every major currency in the world was pegged to the dollar, and the dollar itself was pegged to gold at $35 per ounce. This was the Bretton Woods system, and it gave the U.S. extraordinary power. The world needed dollars to do business. America became the world's financial headquarters. But then came the Vietnam War. The U.S. printed enormous amounts of money to fund it. Inflation crept in. And eventually America's gold reserves, still the largest in the world, by the way, could no longer cover the dollars in circulation at the fixed rate. So in 1971, President Nixon did something drastic. He simply ended the gold standard. No more dollar to gold convertibility. Just like that. And in 1976, at a conference in Kingston, Jamaica, the Bretton Woods system was officially replaced by what we now call the Jamaican monetary system, where currency values float against each other, determined by global markets. No fixed pegs, no gold backing, just supply, demand, and the decisions of central banks. That's the world we've lived in ever since. Now here's the critical thing to understand. When you remove the gold anchor, what keeps the dollar valuable? The answer is fascinating. And it's the reason we're in the situation we're in today. After 1976, the dollar didn't collapse. In fact, it became more dominant. Why? Because the US replaced the gold standard with something arguably more powerful, the global standard. The dollar's dominance today rests on four pillars. 1. The US has the largest pool of liquid capital on earth. 2. America is the world's biggest premium consumer market. Every country wants to sell here. 3. The US stock market is the largest on the planet, a massive engine for wealth creation and speculation. And 4, decades of institutional credibility. The Federal Reserve, for all its flaws, has a track record that younger central banks simply don't have. But here's where it gets complicated. Economists call it the Triffin paradox. If the dollar is the world's reserve currency, the US must supply the world with dollars. That means running trade deficits, importing more than you export, because that's how dollars flow out into the global economy. But running constant deficits weakens a currency over time. So the US has a structural contradiction built into its role. To power the global economy, it must constantly weaken itself. And the numbers are staggering. Today, the US runs a current account deficit of roughly $1 trillion and a budget deficit of $2 trillion. That's $3 trillion in the hole every single year. Yet investors around the world still pour money into dollar assets. Why? Because of that third pillar, the stock market. Since 1971, the Dow Jones Industrial Average has climbed from around 1,000 points to over 42,000. That's a 40 times increase, and it's not a coincidence. it started accelerating right after the gold standard ended. The U.S. stock market became a global inflation sponge, absorbing all those extra dollars that would otherwise cause runaway consumer price inflation. America essentially turned its financial markets into the world's savings account. And for 50 years, it worked, until now. Here's where things get uncomfortable. Since the COVID pandemic, the Federal Reserve went on the most aggressive money printing spree in modern history. At the peak, the Fed's balance sheet swelled from $4.7 trillion to nearly $9 trillion, essentially doubling, as it bought up Treasury bonds and mortgage-backed securities to keep the system afloat. That's $5 trillion in fresh liquidity injected into the economy in roughly 2 years. This is what caused the post-pandemic inflation surge. Most people know that part. What fewer people realize is what's been happening since. Starting in the summer of 2022, the Fed began the reverse process, quantitative tightening, shrinking its balance sheet by about $60 billion per month. It's come down to around $6.8 trillion as of now. And here's the dangerous side effect. Non-printed liquidity in the U.S. financial system has nearly evaporated. Let me explain that simply. The Fed operates what are called repo operations, essentially short-term lending arrangements with banks using Treasury bonds as collateral. This process generates a pool of available non-printed liquidity in the system. Back in the summer of 2022, that pool stood at around $3 trillion. Today, it's sitting at approximately $500 billion, a six-fold reduction. And below $500 billion, economists warn, you enter structural crisis territory. The system starts to seize. Now combine that with what America actually needs to borrow in the next 12 months. Between now and mid-2026, the U.S. Treasury needs to refinance and raise approximately $12 trillion, $6 trillion in short-term obligations, Treasury bills maturing in under a year, $3 trillion in medium and long-term notes and bonds, $2 to $2.5 trillion to cover the current budget deficit, $12 trillion, with $500 billion available. That gap doesn't close without the printing press. This isn't a fringe prediction. This is math. So what do you do when you're the United States and you're staring down a $12 trillion hole? You have three basic options. You cut spending aggressively, politically toxic. You raise taxes massively, also politically toxic. Or you restructure the entire global monetary system in your favor. And that, many economists now argue, is exactly what the Trump administration is attempting. Think about it this way. Nixon's move in 1971 was ending the gold standard of the dollar. What Trump appears to be pursuing in 2026 is ending the global standard of the dollar, deliberately. Here's the theory. America's role as the world's reserve currency has made the dollar chronically overvalued. That overvaluation destroys American manufacturing competitiveness. It hollows out the industrial base. It ships jobs to China. It creates this bizarre situation where the U.S. is essentially outsourcing critical production to its biggest geopolitical rival. The solution? Gradually reduce the dollar's global role. Let it become a strong regional reserve currency rather than the global reserve currency. This allows the dollar to weaken gradually, American exports to become competitive again, and domestic manufacturing to rebuild. The tools being used? Tariffs? Yes. But also something more creative. What some are calling century bonds. Ultra long-term treasury instruments with 50 to 100-year maturities, paying yields below the rate of inflation. In other words, countries that buy them will lose purchasing power over time. Their real value will be cut in half. The plan essentially asks other nations to subsidize America's debt restructuring, to voluntarily park money in instruments that inflation will slowly devour. And the Trump administration's bet? That access to the American consumer market is so valuable and American security guarantees so necessary that countries will line up to do it anyway. Will they? That is the $12 trillion question. There's another piece of this puzzle worth noting: the administration's intense focus on cryptocurrency and digital assets. In a world where the dollar's global footprint shrinks, digital dollar instruments, stablecoins, regulated crypto infrastructure could fill some of the gap, maintaining U.S. financial influence through technology rather than reserve currency dominance. Here's the bottom line, and this is the part I really want you to hear. We may be living through a monetary transition as significant as 1971, and most people have no idea. The parallels are striking. Nixon had no real choice but to end the gold standard. The system had become mathematically untenable. Trump may have no real choice but to end the global dollar standard. For the same reason, the math doesn't work anymore. And just like in the 1970s, the transition will be painful and disorienting. The 1970s brought stagflation, oil shocks, and a brutal recession before Reagan's policies eventually stabilized things. What's the 2020s version of that pain? Potentially, continued dollar volatility, higher long-term interest rates, a repricing of U.S. equities, inflationary pressure, and a messy multi-year rebalancing of global capital flows. Gold, by the way, is already screaming this signal. Since the gold standard ended, the dollar has lost 98% of its value relative to gold, from $35 an ounce to over $3,300. That is the hidden inflation of the last 50 years, finally visible. Let's bring this together. The U.S. dollar became dominant through a system built on institutional credibility, massive liquidity, and the world's most attractive capital markets. But that system created a structural dependency. The U.S. needs to keep printing and borrowing to maintain its global role, which in turn creates the very imbalances that now threaten to undermine it. Right now, America faces a liquidity gap of roughly $12 trillion over the next year, with less than $500 billion in non-printed reserves. The Federal Reserve will almost certainly need to restart some form of quantitative easing, money creation, to fill that gap. Meanwhile, the Trump administration appears to be deliberately navigating a transition away from dollar global dominance, using tariffs, long-term debt instruments, and digital currency policy to reshape how the world relates to American money. This is not the end of the dollar, but it may be the end of the dollar as we've known it for 50 years. If this video helped you understand what's actually happening at the macro level right now, hit that like button. It genuinely helps this channel reach people who need to hear this. Drop a comment below. Do you think the dollar's global dominance ends within the next decade? Yes or no? I read every single response. Subscribe if you're not already. We cover exactly this kind of deep macro analysis every week without the noise. And if you want to go deeper, I've linked in the description a breakdown of what all of this means specifically for your investment portfolio. Equities, bonds, gold, and crypto in the current environment. See you in the next one. Stay sharp.